In this video we are going to talk about dividend stocks to load up on. So before starting this video, please like this video and subscribe to this channel for our future updates. When selecting dividend stocks, it is important to look for regularity in the dividend payments. The decline on the stock market so far this year is at 14%. A number of issues, including investors' worries about inflation, rising interest rates, and unstable geopolitical situations, have contributed to the market's recent decline. But being terrified of the stock market should not cause you to completely avoid it. The lessons of history have shown that an opportunity to invest is best taken advantage of in a market that is currently struggling. Dividend stocks are the way to go for investors who want to get consistent income despite the volatile nature of the market in which they are investing. A hallmark of a stable firm is one that has a track record of continually paying dividends and increasing those payouts. This indicates that the company receives constant money in the form of dividends. Coca-Cola. This beverage business managed to maintain its position even while growth stocks suffered significant losses this year. Because of the profitable business model that Coca-Cola, KO 2.28%, has, due to its geographic variety and marketing initiatives, the company was able to give its stockholders a good return on their investment. In the first quarter, total sales increased by 16% year-over-year to $10.5 billion, while adjusted earnings increased by the same percentage, reaching 64 cents per share. The operating margin increased to 32.5% from 30.2% in the same quarter of the preceding year as a direct result of the robust expansion in the top line. Coca-Cola has a significant advantage over its competitors due to its pricing power, which should allow the company to remain profitable despite the effects of inflation. The corporation is able to maintain its profit margins by passing on the pricing of its raw materials to the end users of its products. Despite the fact that the conflict between Russia and Ukraine has caused it to suspend its business operations in Russia, the company continues to anticipate an increase in its organic revenue of somewhere between 7 and 8% for the full year. It's possible that adjusted profits per share will show an increase of somewhere between 5 and 6%. Coca-Cola anticipates that it will have an adjusted free cash flow for the year of around $10.5 billion. The robustness of its operations provides reassurance that the company will continue to pay dividends for the foreseeable future. In point of fact, Coca-Cola increased its quarterly dividend for this year by 5%, bringing it to 42 cents per share. This is the company's 60th dividend increase. Johnson & Amp, Johnson. Johnson & Amp, Johnson's robustness over time can be attributed to the company's varied operations, which comprise the consumer goods, medical devices, and healthcare businesses. J&Amp, made the decision not so long ago to separate their consumer business into a separate, publicly traded company. The plan is to put more emphasis on the company's core healthcare sector, which seems like it has the potential to generate revenue and profits for many years to come. The fact that the healthcare behemoth has maintained its dividend payments while also raising them demonstrates the importance the company places on expanding its operations. Its outstanding performance in the first quarter is evidence that this premise is valid. The first quarter dividend payment was increased to $1.13 per share, representing a 6.6% increase from the previous payout. Along the same lines as Coca-Cola, this represents its 60th consecutive year of increasing its dividend. When compared to the previous year's same quarter, Johnson & Amp, Johnson's revenue increased by 5% to $23.4 billion, while the company's earnings per share increased by 3% to $2.67. Despite the challenges posed by the macroeconomic environment during the quarter, J&Amp's management considers it to be a successful performance. The largest portion of overall sales was brought in by the company's pharmaceutical division, which offers a robust medicine portfolio. Additionally, the corporation is making significant investments in the costs of research and development in order to bring brand new goods and medicines to the market. Due to the lack of clarity on demand and availability, J&Amp has decided to suspend its guidance for COVID-19 vaccine sales for the entire year. As a result, the overall amount of sales that have been reported could now fall somewhere in the range of $94.8 billion to $95.8 billion, which is a little bit lower than the previous guidance. It is also possible that adjusted profits per share will be in the range of $10.15 to $10.35 rather than the $10.40 to $10.60 range that was projected earlier. Medtronic. Medtronic is a well-known company in the field of medical equipment. The company operates in the cardiovascular, medical surgical, neurological, and diabetes markets. The organization has its headquarters in Ireland, but it has operations in 150 other countries and treats close to 70 different medical diseases. Medtronic has been able to maintain consistent dividend payments to its shareholders thanks to the stability of its company. The company's most recent quarterly results for the fourth quarter offer evidence to support that assertion. The revenue for the 3 months that ended on April 29 was $8.1 billion, representing an organic growth rate of 1% compared to the prior year. However, adjusted net earnings came in at $1.4 billion, which is a significant increase over the previous year's quarterly total of $1.3 billion. The majority of its divisions witnessed growth, with the exception of diabetes, which saw a decrease of 4.8%, and medical surgical, off 1.2%. The company anticipates encountering inflation, supply chain challenges, and other obstacles in the fiscal year 2023, but it has strong growth potential in the medical device segment. In addition, the company has high growth prospects in other areas. Due to its strong performance, Medtronic was able to enhance its annual dividend by 8%, bringing the total payout to $2.72 per share. This is the 45th year in a row that the dividend has been raised. The management of the company stated that the corporation will not deviate from its commitment to return 50% of its free cash flow to shareholders. Procter & Gamble. Procter & Gamble is a name that is immediately associated with dependability whenever the topic of income investment is brought up. Since 1891, P&G has distributed a dividend to its shareholders, and the company has increased that payout each year for the past 61 years in a row. P&G has been a component of the Dow Jones Industrial Average continuously since 1932. There are not many stocks that are as reliable and historic as this one. Additionally, P&G goods have a reputation for being dependable. Some of the most well-known brands in the industry, such as Charmin toilet paper, Crest toothpaste, Tide laundry detergent, Pampers diapers, and Gillette razors, are all owned by the same corporation. Procter & Gamble is sensitive to competition despite the fact that it sells consumer staples, which are meant to be less subject to the ups and downs of the economy. It has been particularly difficult due to the proliferation of discount merchants who sell store brands that are less expensive. Consider the value of the stock as evidence. P&G's stock has had a loss of 2% over the past 5 years, in contrast to the Dow's gain of 65% during the same time period. Walmart. It goes to reason that the stock of the company that is the largest retailer in the world would be one of the stocks with the best long-term performance. However, getting to this point of brilliance was not an easy journey. After accounting for stock splits and dividends, Walmart's WMT share price was only 4 cents when it initially began trading on the New York Stock Exchange in 1972. Today, that share is worth $86.84. Walmart began as a single discount store but has since expanded to more than 11,600 stores throughout the globe and employs more than 2.3 million people. Walmart's humble beginnings can be traced back to when the company was founded in 1962. Walmart was prompted to spend extensively in its e-commerce sector in response to the development of Amazon, AMZN, in particular, as a rival. Early returns from these efforts look encouraging, and the prospects for future returns remain positive. It was decided in February to remove the word stores from the business's official name in an effort to broaden the company's appeal beyond its traditional retail roots. Walmart has grown its dividend payment every year since 1974, and the company has been a component of the Dow since 1997. What do you think of our video? Let me know in the comments section below. If you enjoyed this video and want to hear from me again, be sure to hit that subscribe button before you go. Thanks for watching.